Thanks everybody for coming. I'm Ben Narasin. I'm a venture partner at NEA. NEA, for those of you who don't know, it is currently the world's largest venture firm. Does everything from seed to pre-IPO. I'm going to let the panelists self-introduce so they can tell you how great they are.
I'm Jules. I'm a partner at IVP. We're not the world's largest venture firm, and I know when Sequoia raises the next fund, you're not going to be able to say that, so you're just getting it out one more time.
I'm getting it in now. Like, I'm going to say it literally every day until they close that fund.
Okay, no, NEA is a great partner of ours, and we're a big fan of them. We just do later stage investing, so that's all we do. We've been doing that for basically the last 17 years. We have a $1.5 billion fund where we invest about $30 to $50 million per company. We'll invest in about 12 to 16 companies a year. And we're investors in companies like Twitter, Snap, Slack, Dropbox. It's a fun week. MuleSoft as well. And I've been at the firm for 10 years.
I'm Gene Ramirez. I'm managing director at BTIG. We're a growth-focused investment bank, and part of our product mix is targeting these funds. So glad to be here today.
So we're going to talk about a couple of things and try to leave a little extra time for Q&A. The topic is sort of the evolution of late-stage investing. So I think the place to start is sort of how late-stage investing has evolved in general, sort of past, present, future. Then talk a bit about how late-stage investors think about marketplace companies specifically, some trends we're seeing, and then, as I said, leave some time for questions. So, like, Jules, I've known IVP since I started 12 years ago when Norm taught me what late-stage investing was, and it used to be $25 million of revenue and 10 million or 5 million of EBITDA, and that's evolved. Can you talk maybe a little bit about how you've seen the landscape change?
Yeah, I mean, I think what's happening in venture overall is that there's probably more lines are blurring between stages and even funds in terms of where they focus. So there used to be, you'd raise your Series A, and it was actually a real Series A, not like now you've got the seed and the pre-seed and all that stuff. But you raise your first round, which was your Series A, and then you'd reach different milestones. At each milestone, you could raise additional capital. What's changed a little bit is that with us being more connected in terms of just the power of mobile platforms and in the enterprise, the power of products to spread pretty virally, companies can scale a lot faster. And so we're seeing a lot in our business. Companies where we invest in the company and it's only been around for 18 months or 12 months. We invested, in a company called Supercell, which I don't know if people played Clash of Clans a long time ago, but that company was 9 months old and doing $1 million a day in revenue, and just something we'd never seen before. So it's a late stage company, but it's a 9-month-old company. So it's changed our business a little bit. We're still squarely focused on companies ideally over $10 million of revenue or significant users, but we're finding those businesses a lot faster, and it's causing us to be a lot more focused on using data in our business to help identify companies, and that's led us to do, I'd say, more Series Bs, but again, in larger companies. But again, we're also focused on the companies that scale more linearly. We've never been, I think profits are important in the future, but we've never been a firm that only invests in profitable companies. About a third of our companies are profitable, which we love, but we're really looking for businesses that are focused on growth, and the average growth rate for IVP companies is about 100% a year, and that's at scale. So again, looking for very fast growing businesses.
Gene, how have you sort of noticed this evolve over a bit? How have you seen late stage change, and where do you think it is today?
Well, obviously on the financing front, I think there have been a lot of changes over the years. One in particular, obviously with the growth of China, you've seen a number of investors across the board from, everyone from SoftBank to GIC, even a fund that just moved to San Francisco, Kazana, which is a $35-40 billion Malaysian fund, has been very active on the late stage front. So I think from a financing perspective, there's been additional players who have now moved into the late stage market. I think when companies are seeking capital and they're seeing massive scale, they are now, they'll come to an investment bank such as BTIG and really look at optionality, not only going to the NEAs or IVPs of the world, but also looking at alternative investment type managers. So I think that's probably been the biggest change over the year. It's also had an impact on the IPO market, quite frankly. I think the average, or from a median age perspective, if you look at all the unicorns, they're about 8.8 years. I remember back in the day of Roberts and Stevens, At its peak, it was around 2.5, 2.6 years from inception to IPO. So things have changed considerably. One, because of the cost of capital.
Yeah, there's two really important points there. One is this, which I'd love to double click on. One is the significant changing landscape, and the other is sort of the new realities, not just of companies staying private longer, but what IPO markets expect, which influences all the investors along the way. And it's almost like everything has been pushed down one or two rounds. The seed rounds of today are effectively the Series A's of yesterday, which makes the Series A's of today the Series B's of yesterday, and the Series B is now a growth round. How much of that do you guys see coming from the fact that there has been this period over the last 8 years of new sources of capital from mutual funds, private equity funds, hedge funds, sovereign nations, SoftBank, coming into the market, and how does it make you think about things as a competitor, Jules, and how does it make you think about it as a potential provider of deal flow sourcing and different sources of capital?
Yeah, I think we've got like a very healthy view of competition. So, this may be helpful in just anyone's business too, but we sort of accept competition. Like we just know venture is going to be very competitive. There's no way to just be the only venture firm that does this or the only venture firm. It's too good of a market. There's great, getting to work with entrepreneurs is a really fun job, so it attracts a lot of people who like it. And then it's also a job where, you get from a performance standpoint, if you do well, it can be, really rewarding. And so, so we're going to have a lot of competition. And I think what we really try to do is just focus on our business and what we can do uniquely. And if anything, we've tried to narrow our aperture and say, we want to be the best firm focused on companies going from 50 or 100 people to 500 to 1,000 people. And we've now got 50 companies that are sort of over $50 million, all going through the same things. So that's how we've tried to focus. The market has changed though. I mean, we had like in 2015, it was the peak of kind of mutual fund mania. And we were just seeing companies raising at prices often that were like twice what we were bidding in rounds. We were seeing hedge funds that were getting into venture, and everybody thought it was a great market. And even though overall the macroeconomy has been pretty strong since then, there's been a lot of companies that have been burned at the mutual fund level for doing that, and so we've seen that pull back. But now we're seeing SoftBank and maybe Sequoia and others, and great early stage firms. I mean, NEA has always been a multi-stage firm, but NEA is a great investor for growth rounds too now. And so we've had to sort of just accept wherever the competition happens, and it's almost like this individual, every investment we're trying to make, we're trying to sort of again just compete and do our best, and hopefully the entrepreneurs they see a good fit. But yeah, I've always wished that could be an industry with no competition, but then I don't think it'd be that fun too. So you got to kind of enjoy it and welcome it.
Then you'd be Facebook.
Yeah, even the government's their competition now, it sounds like. So yeah, I don't know.
You made a point actually I do want to double click on because I think you can give some views here. And after this, I want to jump to sort of the specifics of marketplace companies and how you think about them in growth. But yesterday I had an entrepreneur pitching me, and they've raised a reasonable amount of money, and they now have the option of taking money from a traditional venture firm like ours, or from, I'll call it a semi-strategic, hands-off group where they'll put in a lot more money and they'll pay double what I'll pay. But the entrepreneur made a very good point in asking me the question, do you think this will hurt me later? And I struggle with this a lot in thinking about the following. You have 50 companies, or whatever number of companies at 50 million in revenue that you can help because you've seen that movie many times and you'll be active in that company. And I think that added value of knowledge can be enormous to an entrepreneur that's learning. While, I won't name any firm, some big ass source of capital that isn't in this business day to day will put in the money but put in nothing else. How do you both think about the importance of the stage and the knowledge being combined so that entrepreneurs get more than just money?
Yeah, I mean, we're super biased. I think everybody should just raise money from IVP, I guess. They're the great companies, so I mean, it's our business.
Other than the ones we're competing for, in which case you should raise from NEA.
But no, I mean, I think what's hard to appreciate though is that it's hard to raise money, especially at this. I don't know how many entrepreneurs are in the audience here. We have a few. It's hard enough to raise like a seed or a Series A. It's really difficult then to go to the B rounds or the C rounds. And so I think companies that are in the fortunate spot of choosing between IVP and an NEA and a strategic, I just think like you've already made it. So I think you got to feel really great about the business. I think the harder thing is how do you get to the point kind of going from Series A to Series B where you have to move from what I think at the Series A is a very visionary pitch about, this is the market opportunity and the problem we're solving, and here's how we're changing the world, to a little bit what David at Masterclass was talking about in the last panel, which was like, what's your CAC? What's your LTV? Does that model work? Is it scaling? What's the conversion rate? And showing metrics that this business is working, and that's what we're fortunate enough to be an investor in that company, and that's what ultimately is needed. And so I think I don't know where I was kind of going with this long rant, but I do think that it's a less interesting question to me about how do you choose between firms, but more how do you get to a point where you can make that choice because firms are coming after you.
Yeah, the only thing I'll add is that happens quite a bit, as we all know. And what we've seen, I think it's very good for entrepreneurs in terms of optionality. That's the advantage in today's market. But number two, it depends on the quality of management. What sort of options, as I mentioned before, they have in front of them. I know one company we're working with right now, they're going through the same exercise. Do we go with a growth equity fund? Do we go with this sovereign wealth fund? What's the best sort of approach? How will each party sort of help us scale the business even further? And I think it just goes back to the quality of management, their experience. Have they done it before? Or are they executing really well? And the type of relationships these funds have. And that's, everybody sort of has a different sort of approach to the market.
So let's jump to sort of the key to the point you just made, which is when you think about investing in later stage explicitly to marketplaces, that journey from A to B, because you are correct, like it's getting to that next round is always a pretty meaningful hurdle, and there's a glorious time when lots of people care. When you look at marketplaces explicitly as a later stage investor, what are the characteristics you want to see? What are the sort of magic numbers that you care about, if that's what you care about?
Yeah, I think what we look for, we look for a lot of the same things in marketplaces as we look for in every other business. Obviously, growth and an efficient acquisition model. I think with marketplaces, what we love seeing is where you've got dynamics where you've got almost some organic growth in the marketplace, a word of mouth thing. To use Masterclass again, it's Gordon Ramsay telling David Beckham he should join. Those are things that on the supply side of creators that you don't normally see. And so is that also happening on the demand side? So I think there's a lot of things around that, but ultimately it's a lot of the same metrics of efficient sales model, efficient growth, marketing engine, and is there health in the business? And then I think we also talked a little bit about this, but I think a lot of marketplaces, a lot of entrepreneurs have this view that I just need to raise the most amount of money because it's winner take all, and ultimately I prefer the marketplace entrepreneurs that are more focused on what are my metrics say and how efficient am I as a business, and if you do that, you will be the winner. So that's one thing to think about.
So let's open it up to Q&A. We've got 5 minutes for that, if there are some. There's got to be some brave souls, sure.
So when you're looking at investing in a company, you're talking about CAC and LTV and all the basic metrics of the business. And if, generally speaking, the metrics are good, but there are some challenges, is that the kind of thing that you would think about, or you would say, no, you guys aren't ready, right? Go solve that problem and come back to us?
Yeah,
we don't. Where you feel like you've got the skills in other $50 million companies to actually come in and help.
No to that. We do think we can help, but we're not going to fix. We're not an auto mechanic that's going to fix a broken engine or anything like that. So, but I'd be interested in kind of NEA and BTIG's thoughts too. But we want businesses. We don't expect perfection, and I think that's unrealistic. Every business has things to work on, but what we like to see is some sort of freak of nature metric that the company has. So, for example, I always do the analogy of we want to find LeBron James when he's 14 years old and dunks 360 dunks. He might actually not be a great three-point shooter at 14. He's going to work on that later, and some of his dribbling skills might not be there, but he's got some freak of nature ability that differentiates them from everyone else. So we'd rather find that type of business in a Series B or Series C than we would just kind of everything's okay in the business. So,
it's just to make a quick commentary on that. I think it's pretty investor specific, and by that I mean partner specific versus firm specific, how much they are willing to tolerate in terms of challenges. I agree with it. Someone once said to me, when I brought them a company that was seed backed that I had funded, and I wanted them to do the Series A, and they said, I don't see an unfair competitive advantage here. I was like, well, that seems unfair. It's like, yeah, but I've got to have it. If I don't have an unfair competitive advantage, I can't fund the company. So there is that thing that makes you say, wow, and then there's all the other parts. I love the auto mechanic example. I had a partner at a prior firm who used to use the analogy, which I vehemently disagreed with, that what you really wanted to do was find the house with good bones, but you needed to do a whole lot of construction on it. And I was like, that is the single worst thought I've ever heard in venture. The best companies need the least help. It doesn't mean we don't put our shoulder to the wheel, but entrepreneurs are the ones that drive their companies. They're spending 99.9% of the time compared to what you are. You do everything you can to create business development opportunities or help introduce great people and provide aid and provide guidance and tell stories. But net, it's what's the tolerance level? If he can, let's put it this way, if he can dunk, I'm not a sports guy, but he can't walk, that might be the challenge that would be hard to get past. But otherwise, I like that dunker.
Yeah, the only thing I'll add is when we're evaluating sort of these late-stage online marketplaces, is it a vertical marketplace, a horizontal marketplace, or is it global? Or could it be a hybrid? Clearly, on everyone's mind, especially from an investor perspective, would be both from on the buy side as well as on the growth equity side. What's Amazon doing? And it's always on everyone's mind. So that's just something to think about.
I think you were next up. Got it. How do you think about debt in the capital structure? So I used to run the equity practice for a venture debt shop. I'm not
Do you work at a venture debt
fan
firm?
of debt.
Okay.
There are some logical cases where it makes sense. Plant and equipment. If you're building a data center, like you really want to use equity for a data center? But otherwise, I think debt can be a challenge in a lot of cases. Yep.
Do you actively seek out businesses with network effects kicking in, and how do you give a playbook for uncovering that and the virality that you spoke to earlier?
Yeah, I think this network effects is this magical word in venture that somehow if you find a business with network effects, everything will be perfect. And you see that in Facebook has massive network effects and Snapchat and stuff like that. So I don't think we love network effects, but I think in some ways people have overplayed the network effects and they assign it to things that maybe there necessarily isn't. And I use the example a little bit of their dating sites have network effects, right? But there's probably like 6 or 8 dating sites of scale, and no one sort of won that market. And so I don't think network effects can get you certain ways, but in some sense, I don't think it's like a panacea for also like having a great business.
2 years ago.
Too many people just use the word and say, oh, it's got great network effects. Oh, I'm in. Okay, I want to learn a little more.
Used to be that everybody told you their viral quote. I haven't heard that quote in a long time.
K factor.
There you go,
Yeah.
K factor. And there was one more over here we might be able to get to.
Just for late stage companies, unit economics, is there like a rule of thumb, like how consistent, how many months or how many years of consistency you like to see, or is it basically just dependent on the business?
Yeah, I want to see more than a couple months, ideally, and especially with like data around churn or things like that. Like if you have an annual subscription like Masterclass and you don't have data on the churn after a year, it's really hard. But I don't need to see years and years. And I think we're looking for trends, and again, something that gives us confidence that this thing's going to continue. So non like one-time events, and we also look a lot, especially at channels of growth. So like if they've just grown through Facebook, but that's starting to CPAs are starting to get higher. I want to see diversity of marketing channels.
There was actually, I'm going to ask you guys a question. There were several people in some of the earlier panels comment on the fact that sort of, they didn't put it this way, but I've heard some people say that growth hacking is for weak companies. Where if you're having to artificially overpay to get that growth in the first place and it's not at a sustainable rate, obviously it's a challenge. But do you need to see an organic level of growth? That's not network effect necessarily, but that supply-demand equilibrium that comes from nature versus from I just went out and hired whoever Josh Ellman's disciple is to be the growth hacker of the moment. Josh is awesome, by the way.
So, do you want to, or you want me to go? So I have a strong view on growth hacking, and it's interesting. I mean, growth hacking sort of lost its luster, I think, in the last couple years for some of those reasons. But it was interesting. I did a project in business school 10 years ago when all the growth hacking stuff was first coming out, and K Factor, and we interviewed a bunch of companies, everything from like Plaxo to Sean Parker and like just some really interesting people, Max Levchin, and we met at one point with Roloff from Sequoia, who I've got a lot of respect for, and it was really interesting because he was talking about YouTube in like the early days, and what was amazing is that YouTube had the best K-factor and growth and all that stuff and best growth metrics, but they didn't do anything to actually juice that. It was just an incredibly viral, organic product, and I think ultimately, like, growth hacking can help a business improve, but it's not, again, it's not where you start to make a business successful. So you start with a great product that people love, and then ultimately it leads to great growth hacking metrics. So, but I think Facebook's done a great job of having a great product, but then using growth hacking to accelerate the business even further. I think Snap, which we're an investor in, I think was probably late in doing that, and I think has the capability to catch up in some ways because of that. So growth hacking is important, but it's after you've gotten a lot of stuff right.
Other questions? You can drift down a lot of rabbit holes if you want.
How do you guys get involved when your companies are looking at M&A?
How do you get involved when your companies are looking at M&A?
I guess it depends, at least from an investment banking perspective, what stage you are. From a development perspective, we typically look at mid to late stage, companies. So everything we look at is, again, massive scale, efficiencies from a marketplace perspective, the take rate, lifetime value over customer acquisition cost, efficiency across the board. And once they have that, and something unique and differentiated is obviously very important. So that's sort of how we look at it. From a public perspective, you had a couple examples that sort of went out last year from Blue Apron, which is probably not a good example. We could debate that model, but there's been a number of other companies such as that, and so forth. So I think people are still very optimistic about the online marketplace from a public perspective, and I foresee a few others coming out this year.
You want to address that at all?
With M&A, you mean like when do we personally get involved in helping with M&A? Definitely. So especially for the companies we're on the board of, we all rely on really good investment bankers because when you're kind of getting down a path, it's often good to have experts. It's really hard to sell a company. Most companies, it's kind of a cliche, but like most companies are bought, not sold. So so the best time is actually build a great business, get someone to think they want to buy you, and then involve an investment bank and try to get other bids to enhance the value. We also help a lot when our companies are buying smaller companies. I think that's also really fun. And how do you help a business that's never digested another team or product or company? And so we really get involved there. And in some cases, we'll even do diligence on the target to help the company. But M&A usually is also not, it's something that can augment. It's kind of like growth hacking that can augment your business, but it's not probably the first place to start.
Yeah, and I've sort of seen this across 3 different firms, and again, it's somewhat partner specific and very management specific and stage. So I think of M&A as falling into 2 camps: M&A of weakness and M&A of strength. As an investor, I want to believe any one of my companies has the opportunity to be a freestanding public company. So M&A de facto is not my goal. Although, as an example, MuleSoft just got bought post-IPO for $6.5 billion, which we're both very happy about, and it's a phenomenal company. So there's the times when your company is perhaps no longer on a venture trajectory, but is still a valuable company, and that would be a slightly more sign of weakness type of M&A structure, but still great value can be created. Then there's the inbound triggering an interest at a level that's appropriate, where you say, okay, well, we've got interest at this level, and that is the right answer for this company at this point, which you almost always then look out to engage a banker to help find the maximum number of options and find the best possibility. On the earlier one, also bankers typically involved as well, but depending on size and structure, you have different types of people that do that sort of work. And lastly, in very rare cases, you have entrepreneurs that are raising, where you might see some specific strategic investor that could be valuable, and you might want them to have some aid. And you look again at the management team and say, do they have all the resources they need to be able to do this well? And so in a very, 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 very rare instance, you might actually engage somebody even pre-M&A and that sort of instance. We're down to the end of it. So I'm going to say thanks to these guys, and thank you guys for coming.